Accounting is regarded as the language of business. All stakeholders in the firm rely on this terminology to understand the company's financial status and net worth. It is essential in the company because it allows you to track income and expenses, assure statutory compliance, and provide investors, management, and the government with quantitative financial information that can be utilized to make business and financial decisions. This course is intended to assist beginners in gaining essential accounting information. After finishing this course, students will have a solid understanding of some of the fundamental ideas of accounting, such as the golden rule of accounting, processes, accounting concept, and many other critical areas of accounting. So, without any further ado, let's get started right away. If you haven't subscribed to our channel yet, I want to request you to hit the subscribe button and turn on the notification bell so that you don't miss out on any new update or video releases from Great Learning. If you enjoyed this video, show us some love and like this video. Knowledge increases by sharing, so make sure you share this video with your friends and colleagues. Make sure to comment on the video for any query or suggestions and I will respond to your comments.
Hi, welcome to this video on basics of accounting. In this video, we are going to discuss all the basic terminologies of accounting. So first, we'll see what is the agenda for this session. So first one, that is bookkeeping. Second one, meaning and definition of accounting. And next, we'll discuss about functions of accounting. What are the major functions of the accounting that we will discuss. Next, process of accounting, that is one by one, the stage by stage of accounting process will see. Difference between bookkeeping and accounting. Next, users of accounting. So who are the users of the accounting and what is the purpose of using these accounts? Okay, that we will discuss. Next, types or branches of accounting. What are the main types or what are the major types of accounting are there that we will discuss. Next, accounting concepts. So we have 9 accounting concepts that we will discuss, and then accounting convention. At the end, we are going to discuss about golden rules of accounting. This is the base for all the accounting. Bookkeeping. So what do you mean by this bookkeeping? In general also, we can use this word or we are going to use this word bookkeeping. It is nothing but we are going to maintaining a book or we are going to record whatever the activity or whatever the transaction we are going to do, that we are going to record. That is called as bookkeeping, correct? In general. In accounting, what do you mean by this bookkeeping? In accounting terminology, the bookkeeping is nothing but it is the art of recording business transaction in the books of accounts in the ordinarily manner. What do you mean by this ordinarily manner? If, for example, if you visit any institution, okay, institution or company you are going to visit. So on that time, the security officer, what he is going to do is going to record whatever the details, your details is going to record, correct? So your name, what is the purpose of visit, for which department you are going to visit, and what is the time you are going to visit to the institution, all those information is going to record, correct? Like that only in the business also, whatever the day-to-day activities or whatever the operations they are going to do, all the activities they are going to record in the books of account, that we call it as bookkeeping. We'll see what is the definition of bookkeeping. So bookkeeping is the science and art of correctly recording in the books of accounts all those business transactions that result in transfer of money or money's worth. So it is not just recording the transaction or recording the activity. It is a art. Okay. Simply we cannot record all the transaction. So in a order or in a systematic manner, we need to record all the transaction, and that will be useful for the further books of accounts. So they need to maintain this bookkeeping in a systematic manner, and whatever the activity we are going to record, okay, that we need to measure in terms of money or equivalent to the money's worth. Okay, we cannot measure all the transaction in terms of kg or kilo or grams, whatever other. Okay, we need to measure in terms of money only. Okay, so that is called as bookkeeping, and this bookkeeping is also known as primary books of accounts. We'll see what is the meaning and definition of this accounting. So for this accounting, the standard definition is given by American Institute of Certified Public Accounts, that is AICPA. Okay, that is the standard definition for accounting. Accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transaction, and events which are in part at least of financial character and interpreting the results thereof. Accounting is the art, that is art of recording. Okay, everyone can maintain the books, but not in the specific manner. Correct? For example, I'm going to maintain books of accounts in my own way, or some other person is going to maintain in his own way. Okay, so everyone, they are going to maintain their daily activities or daily transaction in their own ways, but as per the accounts, it is an art. We need to record all the transactions or all the activities in a systematic manner. We need to record in a particular manner, then only we can use for further activities. Once we record the transaction, next we need to classify. What do you mean by this classification or classifying? Classifying is nothing but we need to segregate the all the transaction, whether it is a asset, liability, it is a expenses, revenue, equity, or debenture. Like that, we need to classify all the transaction. After that, we need to summarize. Summarize is nothing but we need to record at the manner. The general public also, or common layman also, he can understand the transaction. Okay, we need to summarize the transaction in a significant manner and in terms of money. I've already discussed, okay, whatever the transaction we are going to record, we need to record in terms of money only. Transaction and events which are in part at least of financial character and interpreting the results thereof. So after recording, classifying, summarizing, we need to analyze the results and we need to interpret the results there only. And we need to communicate to the management, correct? So we need to get the results there. Next, the process of accounting. So what is the process of the accounting? The first step is to identification of accounting transaction which have documentary evidence. So for whatever the transaction or whatever the activity we are going to record in the bookkeeping, for all the transaction we need to give the appropriate documents. For all the transaction we need to collateral with the documents or proof. Without proof or without evidence, we are not going to considered as a business transaction. If it is 10 rupees or if it is 1 lakh rupees, for all the transaction we need to give the supporting documents, then only we are going to consider as a business transaction. That is the first step. Second step, classification into assets, liabilities, capital, revenue, and expenses. That is classifying. Once we record the transaction, we need to classify which are the categories of items are there. Whether it may be comes under the assets or it may be under liability or it is a revenue or expenses or capital. In this way, we are going to classify all the transactions. And next, preparation of income statement. Income statement, it consists of your P&L account, profit and loss appropriation account, and the balance sheet. Okay, so in this, once we get the classification of all the transaction, we are going to complete the income statement. That is the third step. And the last step, once we get the financial statements, last we are going to communicate the results. For whom? We are going to communicate the results to the higher ups. That is the management, and for the owners, we are going to communicate the results. Next, functions of accounting. So these are the 6 major functions of accounting. So we'll see one by one. First one, recording, classifying, summarizing, analyzing, interpreting, and communicating. So these are the 6 functions of accounting. So first one, a recording. So recording we are going to do in the bookkeeping. That is our primary books of accounts. In that we are going to record the all the transaction or all the events or all the activities which in terms of money or money's worth that we are going to record in the primary books of accounts. That is the first function of accounting. Second one, classifying. So once we record the transactions, okay, we need to classify it into whatever the categories are there: assets, liabilities, revenue, expenses, capital. In that also we have various types of assets are there and liabilities are there. Capital also. In that capital also we have share capital, that is equity share capital, preference share capital, reserves and surplus, retained earnings, debenture. So these are the different types of capital we have, and revenue and expenses. So these are the classifications. We are going to classify it into these are the categories. Next, third function is to summarizing. So we need to classify first. After classification, we need to summarize whatever the transactions are there and for which accounts. Okay, whether it belongs to trading account or P&L account or P&L appropriation account or in the balance sheet or trial balance, for whichever, okay, that is we need to post it to the respective accounts. That is the summarizing. We need to summarize the all the accounting transactions. Next, analyzing. We need to analyze each and every transaction. Okay, we need to analyze the transactions in a manner that whatever the tools or whatever the accounting tools or accounting techniques are there, using all the tools and techniques, we need to analyze the accounting books. Okay, then only we are going to get the appropriate results. So if for example, financial statements, if you need to analyze the financial statement, means we have 6 tools. First one, common size, comparative statement, trend analysis, ratio analysis, cash flow statement, and fund flow statement. So these are the 6 tools are there. So using these 6 tools or techniques, only we need to analyze the financial statement. Like that for accounting also, whatever the tools and techniques are there, we need to use, and then we need to analyze the results of the organization or results of the company. Next, interpreting. Interpreting is nothing but the common man or the layman also can understand by reading the whatever the interpretations are there. Just he need to read and he needs to get to know what is the financial position of the company. Like that, we need to write the interpretation. And the last one, we need to communicate to the higher ups. Higher ups is nothing but the management or the owner or the stakeholders. For them, we need to communicate the results. Next one is process of accounting. So this is the very important topic in this session. Okay. So process of accounting. First, what are the process or what are the steps or what are the stages or involved in this accounting process? So in this, we have 6 steps in the process of accounting. First one is bookkeeping. That is your primary books of account. All the transaction we are going to record in terms of money or money's worth, correct? That we need to take. That is the first step. Second step, we need to pass the journal entry using the or applying the golden rules of accounting. We need to pass the journal entries. Once we pass the journal entry, the third step is we need to post it to the ledger account. So individual account we are going to open and we are going to calculate the closing balances of that individual account. That we are going to do in the ledgers account. Once we get the closing balances of individual account, next we need to prepare the trial balance. So in the trial balance, in the debit side, we are going to record all the losses, assets and expenses. We are going to record on the debit side. And when it comes to the credit side, we are going to record capital, liability and income. We are going to record on the credit side of the trial balance. So once we prepare the trial balance, with the help of trial balance, we can prepare the financial statement. Financial statements in the sense, we need to prepare the P&L account. Okay. After that, we are going to prepare P&L appropriation account and we are going to prepare the final balance sheet. So these are the 5 steps are involved in the process of accounting. Next, difference between bookkeeping and accounting. So we already discussed what you mean by bookkeeping and what you mean by accounting. So now we will get to know what is the difference between these two. Okay. So we'll discuss one by one. Bookkeeping. So in the bookkeeping, to prepare original books of accounts. So where we are going to use this bookkeeping or whatever the primary books of accounts to prepare original books of accounts. Where we are going to use this bookkeeping means to prepare the original books of accounts. So we already known what is the steps involved in the accounting, correct? So first step is bookkeeping. Once we record the transaction, then only our actual books of accounts will start. Our original books of accounts will start, correct? So first, with the help of bookkeeping only, we need to start the original books of accounts to record, analyze and interpret business transaction. So first step in the bookkeeping, once we get the recording, then only we are going to start with the actual accounts, that is analyze interpreting the transactions or business transactions. Second, recording the business transaction. The main function or main role of this bookkeeping is they need to record all the transactions. In the accounting, it has wider scope. Here in the bookkeeping, only recording the transactions are there. But when it comes to the accounting, it has a wider scope. That is, we have very huge demand in the market. Correct? Next point, clerical work involved in it. So in the bookkeeping, the clerical work, that is, we need to record, that is our traditional method using the paper and pen or books. Okay, we need to record all the transaction. That is the clerical work. While it comes to accounting, it is concerned with low level, medium level, and even top level management. So all the 3 levels of management also they are going to involved in this accounting. It is dependent on accounting, which mean it is meaningful and purposeful. So this accounting is dependent on this bookkeeping. Without the bookkeeping or without the records of the bookkeeping, accounting is not going to complete. Okay, even it's not going to start also, because once we get the transaction, then only we are going to start with the original books of accounts, correct? So bookkeeping is the independent and accounting is the dependent one. Accounting is based on bookkeeping, which is initial and vital part. So in this accounting, it is the initial part. Okay, we need to start with the journal entry, ledger account, trial balance, and then we are going to conclude with the balance sheet. And it is a vital part or vital part, means all over all the stakeholders or all the employees, all the management, they are going to use this accounts. It does not show the net results of financial position, because in the bookkeeping, just we are going to record the transaction, whatever if for example, if we are going to purchase the raw material, What is the value of raw material we have purchased? For example, 50,000. So we are going to record purchase of raw material from XYZ person for rupees 50,000. So we are not going to get the what is the result or what is the output of that, correct? So only output or results we are going to get in the accounting. The net results we are going to get in the accounting, because after recording we are going to do all the books of accounts, or we are going to complete all the books of accounts. Then only we can get to know the net results of the company or financial position of the company. Last point, accounting concept and conventions are followed. So we have 9 accounting concepts and 4 accounting conventions are there. With this 9 concepts and 4 conventions using, and then only they are going to record all the transactions in the bookkeeping. And in the accounting, method of reporting and interpretation may be vary from firm to firm. If for example it is a sole trading concern, they are going to maintain the different way of books. Or if it is a petty shop, okay, they are going to maintain in their own way. Or if it is a joint stock company or HUF, they are going to maintain as per the accounting standards. So these are the difference between the bookkeeping and accounting. Users of accounting. So users of accounting means who are the stakeholders or the employees or whoever it may be, okay, they are going to use these books of accounts. So these users of accounting, we are going to broadly classified into two categories. That is internal users and external users. So we'll see one by one who are the internal users of accounting and who are the external users of accounting. So first one, owners or the management. They are the main persons. They need to check the books of accounts. Why? Because whatever the profits are there, from that profit they need to expand the business or diversification of funds, or they need to start a new product line or new business venture. Okay, for what all the other activities they need to check these books of accounts. Second one, investors. So these investors, they are going to invest their money in the organization in the form of shares, that is equity shares or preference share, or they are going to invest their money on debentures, bonds. Okay, so they need to check the books of accounts. Why? Because whoever the investors are there, they are going to first look at the 3 points. Which are the 3 points? Means safety, liquidity, and return on their investments. So these are the 3 points. How they are going to check? Through these books of accounts only they can check these 3 points. Safety. If for example, if I have invested 1 lakh rupees in XYZ company share, so I need to look at the safety that 1 lakh rupees I have invested in this company, whether it may be a safe or not, or it may be a secured or not. First, I need to check. Second one, liquidity. Liquidity is nothing but whenever I require the money, on that time I can sell my shares and I can get back the money. Or after 3 years or after 5 years, whatever the duration or maturity period they have mentioned, on that time the company is able to pay the money or not. That we need to check. And the third point, a return on investment. If I invested that 1 lakh rupees on that company shares, how much returns I'm going to expect or I'm going to get? I can invest on bank, that is on the fixed deposits I can, or any other activities also I can invest their money. But how much return I'm going to get in this particular XYZ company shares, that I'm going to look. So I need to get these 3 points, means I need to check the books of accounts. So the investors also, they are going to check the books of accounts and then they are going to get the clarity on these 3 points. Next, managers. Managers also, it is very important to use the books of accounts. For example, the purchase manager. The purchase manager, he needs to check the books of accounts. Why? Because what is the last year they have ordered? Okay, in this current year, how much raw material they have ordered, and what may be the next year they need to order. For that, they need to do the budgeting. correct? So for that purpose, they need to check the books of accounts. When it comes to the marketing manager also, whatever the current year sales are there, in that how much is the cash sales and how much is the credit sales. With that help, it needs to forecast for the next year. If for example in this year 1 lakh number of units products are sold, so according to that, he is going to plan for the next year. Why he needs to plan? He is to give the approximate number for the production department. Production department, with that number only, they need to start operating activities, or they need to involved in the producing activity. Correct? So these managers also, it is very important to use the books of accounts. And the last one in the internal users, employees. The employees also refer to these books of accounts. Why? Because according to the or whatever the profit they have made, with that profit, some companies they are going to issue bonus or incentive or hike. Okay, all these they are going to do in the organization. So for that purpose, they are going to check these books of accounts. And next, external users. So in this external users, first one, lenders. Lenders is nothing but the banker or financial institution. They are going to lend money to the organization, correct? Or to the business. So if they want to lend the money means they need to check the past year records. Okay. So last 3 years or 5 years financial statement they are going to refer, and then only they are going to sanction the money for the business. So the lenders also going to use. Suppliers. Suppliers is nothing but the creditors, one who gives the goods on the basis of credit to the business, or with whom we are going to purchase goods on the basis of credit. We call it as creditors. So creditors are suppliers. They need to supply their raw materials, correct? The creditors also they are going to check these books of accounts. Why? Because whatever the credit repayment period they are going to allow for the business, and what is the fixation of the raw material price per unit. Okay, for that purpose also they need to check the books of accounts. Next, customers. So customers, for the quality and the quantity purpose, they are going to check these books of accounts. So if it is, I think so, you know, economics of scale and economies of scope, correct? So if they have the bulk orders, then the cost of productions also it is decreased. So whenever the cost of production is decreased, they are going to give that product at a reasonable price or for the least price. So the customer also they are going to use. Competitors. Yes, competitors, they are going to use the business accounts. Why? Because for the purpose of merging, acquisition, or for any other purpose, they are going to use the other competitors' books of accounts. Government, yes, government is going to use the books of account for the purpose of tax collection. And the last one, public. So all the general public also they are going to refer to these books of accounts. Okay, why? Because they need to know what is the financial position of that particular company. And if you go for any company websites, okay, in that you have specially or specifically they are given tab for financial statements. So in that you can get to know what is the financial statement or what is the financial statements of that company. It is available on the website. You can check also. Elements of accounting. So in the accounting, we have these 5 elements. So we'll discuss one by one. First one, assets. So these assets, the company or the business or the organization, they are going to invest for the purpose of future profit, whether it may be purchased for full cash or it is for higher purchase or for any other things. Okay. Why they are going to purchase or why they are going to invest money on these assets means for the future benefits. For example, plant and machinery. They are going to invest crores together on the plant and machinery and they are going to purchase, correct? So, but they are going to use that plant and machinery for the production activity, future profit or for future benefit only. For example, land and building. They are going to invest crores together on the land and building. Why? Because they need to set up new plant or product line or for any other process. Okay, so they need to use the land and building, correct? So this is the first element of this accounting, assets. So in the assets also we have two categories: fixed assets, current assets. Under fixed assets we have two category, that is tangible assets, intangible assets. Under tangible we can touch or we can feel. Intangible we cannot touch. Okay, for example, goodwill. Next, liabilities. In the liabilities also we have two kinds of liabilities or two different types of liabilities we have. One is long-term liabilities and short-term liabilities. Under long-term, we have two categories, that is secured and unsecured. Secured loans or secured liabilities, or it is collateral with the other assets. Unsecured loans or unsecured liabilities, or it is not given any collateral. And it is current liabilities is nothing but the short term owes to others. In a simple meaning, assets what the business owns, and the liabilities the company owes to others. Okay, and the main difference of these assets and liabilities: assets we are going to invest for the future benefits, and liabilities it is already we taken the benefits, so for that purpose we are going to repay the money, that is called liability. For example, assets I have already told you that example, plant and machinery and land and building. When it comes to liabilities, we are going to take the loan. We have already taken the loan, for that we are going to repay. That is liability. Equity. Equity is nothing but the small amount of money we are going to collect or we are going to pull from the all the investors. And equity shareholders are the real owners for the organization, and they have the voting right also. If company have the profit, yes, they are going to enjoy, and if they have any losses, they need to suffer or they need to bear the losses also. Revenue. Revenue is nothing but the income. The company is going to getting recurring in nature. Every day they are going to receive, or 2 days once or 3 days once, they are going to receive this revenue. The main revenue for the organization is sales, and the expenses, all the money they have spent. Okay, whether it may be a rent paid, salary paid, interest paid, commission paid, loss on the sale of assets, or goods destroyed by fire, all these are expenses, that is loss for the company. So these are the five elements of accounting. Types of accounting. So these are the three major types of accounting. First one, financial accounting. So financial accounting is nothing but all the bookkeeping or all the records. Okay, whether it may be a income statement, P&L account, balance sheet. Okay, all this comes under the financial statements. So we need to record all the transaction and we need to summarize and interpret the results. For that purpose, we are going to use this financial accounting. Next, that is second one, cost accounting. Cost accounting, it is mainly used for to fixation the price per unit. If, for example, the company involved in the production activity, the company is going to produce one product, means for that production, what is the per unit? Okay, for fixation of that price, they are going to use, are forecasting the what is the estimated cost for the production. For that, they are going to use, and what is the operating efficiency. With the help of cost accounting only, they can find out the operational efficiency of the company. And the third one, management accounting. This management accounting is used for the decision making. The management is going to use whatever the tools and techniques are there, correct? So using that, and they are going to take the managerial decision towards the organizational growth. So for that purpose, they are going to use this management accounting. Except these three, we have few more types of accounting is also there. That is emerging trends of accountings are there. One is tax accounting is there, corporate accounting is there, and human resource accounting is there. So these are the three emerging types of accountings are there. That is recent types of accountings are there. Accounting concepts in the bookkeeping. Okay, while recording all the transaction, they are going to consider these 9 accounting concepts and 4 accounting conventions. Then only they are going to record. That we already discussed, correct? So we'll see what are the 9 accounting concepts. So this first one, business entity concept. What do you mean by this business entity concept? So business means here the two parties will be there, correct? One is the business and one is the proprietor, that is owner. So while recording the transaction, he needs to maintain his books of accounts in a manner that the business transactions are different and his own, that is personal transactions are different. In that way, he needs to maintain the books of accounts. So sometimes what happens? Intentionally, the proprietor, they are going to record his personal transactions also in the business transaction or in the business books of accounts. Why? Because to show the lesser profit, to manipulate the books of account, that is for window dressing, they are going to use these tactics. Okay, so as per the business entity concept, the business is separate, the entity, that is the proprietor personal, is different. So these are the two different entities are there. So we cannot merge. Okay, we need to separate, we need to maintain separate for business and we need to maintain separate accounts for proprietor. Second one, going concern concept. What do you mean by this going concern concept? All the business or all the activities or trade, they are not going to start for 1 day or 2 days or for week. Okay, if I'm going to start a new business means my intention is to, I need to sustain in the market for a long run, at least for a 15-20 years or 50 years or 60 years, correct? So all the business, they are going to start with that intention only. So they need to sustain in the market for a long run. That is the going concern concept. We need to look at the future. That is going concern concept. Next, cost concept. Cost concept is nothing but whatever the transaction we are going to record, okay, that we need to measures in terms of money, correct? But we need to calculate also the per unit. If for example 15,000 rupees is the fixed expenses for per month for a factory expenses, so in that 15,000 how much is the per unit cost, that we need to calculate, correct? So for that purpose they are going to use this cost concept. Next, dual aspect concept. Dual aspect concept, I think so you already heard this word or you are going to read these two words frequently, that is debit and credit. Whatever the banking transaction you are going to do, you will get a message or you are going to get a mail stating whatever the amount debited or whatever the amount credited, all the transaction you are going to get, correct? So debit is nothing but when cash goes out or money goes out from the account, then we are going to get debit. And whatever the money we are going to receive or that amount comes to our account, then we will get the credit message. So debit is outflow, credit is inflow in a simple word. So all the transaction, we have this debit and credit, that is two side effect. That is the dual aspect concept. Next, money measurement concept. Money measurement concept is nothing but whatever the transactions or all the activities we need to record in terms of money or money's worth only. Okay, we cannot record the transaction in terms of kilogram or millimeter or whatever the other. Okay, we cannot measure, correct? So we need to measure in terms of money only. Accounting period concept. Accounting period concept is nothing but all the books of accounts or all the companies, okay, they need to maintain in a systematic manner, that is 12 months. It starts from the 1st April of this year to ends with the next, that is 31st March of the next year. All the companies, they need to follow this accounting period concepts only. If the accounting concept is not there, then I can maintain or I can record my books of accounts or I can maintain my books of accounts for 6 months, 3 months or 8 months or 12 months. Whatever it is benefit for me, I'm going to record like that, correct? Other company, they are going to record their own period or accounting period, correct? So for that purpose only they are given this accounting period concept. So all the companies, they need to maintain their books of accounts. It consists of 12 months period starting from the 1st April of this year and ending on the 31st March of the next year. Realization concept. Realization concept is nothing but for all the assets. Okay, we have three varieties of values are there. First one, original value. Second one, book value. And third one, it is realized value or market value. Okay, all the transactions, okay, all the assets transaction, we are going to record first at the original cost. Once we deduct the depreciation, then we will get the book value. So we need to know what is the actual or realized value. Means the market value is the realized value, that is the correct value for the assets that we need to record. Matching concept. So all your books of accounts will need to match. For example, if we start with the debit side, if for example, if we are going to start the individual ledger account, we are going to start with the opening balance, means we need to close with the closing balance, or we need to end with the closing balance, and then we need to match the opening balance and closing balance. If it is difference is there, balance carried on or balance brought down, that we are going to do, correct? Like that. Or for example, trial balance, we need to match our debit side with the credit side. In the balance sheet, we need to match our asset side with the liability side. So we need to match both the sides. And the last one, objective evidence concept. So objective evidence concept is nothing but for all the activities or all the transaction, whatever we are going to record, for that we need to supporting with the evidence or supporting with the documents. I've already explained you regarding this, correct? So if they are not going to give the evidence or proof or documents, means that we are not going to consider it as a business transaction, that we are not going, that we are going to consider as a non-business transaction. So we need to give the documents for all the transaction. So these are the 9 accounting concepts are there. Accounting conventions. In this we have 4 accounting conventions are there. First one, convention of disclosure. Convention of disclosure is nothing but we need to disclose the books of accounts. In this video, I've already told you all the companies, they need to disclose their financial statements in their website. Okay, for the purpose of public or stakeholders, for any other purpose. Okay, they need to publish. So they need to disclose their books of accounts. Second point, convention of consistency. So consistency, you all know, they need to maintain a uniformity, correct? That is the consistency. So convention of consistency is nothing but the company needs to maintain the consistency in the method of accounting. While it comes to depreciation, we have straight line method, WDV method, annuity method. So the company they need to maintain uniformity. If for example, 1 month in a year they are going to use straight line method, other 6 months they are going to use WDV method, in another 6 months they are going to use some other methods. Okay, that is wrong. They need to maintain a same method for the particular year. If they want to change, yes, for the next year they can change. But in this year, they cannot. That is they need to maintain the consistency. That is the convention of consistency. And the third one, convention of conservatism. So convention of conservatism is nothing but they need to maintain all the books of accounts in a systematic manner, and they need to show it to the other stakeholders. And the last one, convention of materiality. So convention of materiality is nothing but they need to record all the transaction, whatever the possible losses are there. Okay, they need to show, and whatever the possible profits are there, they need to disclose to the accounting, or they need to show in the accounting. That is materiality and immateriality will be there, that they need to showcase. That is the convention of materiality. And calculating this materiality and immateriality, it is very difficult. Golden rules of accounting, like it is a base for the accounting. Okay, without these golden rules of accounting, we cannot do any other books of account, or we cannot maintain any books of accounts. So these golden rules of accounting broadly classified into three categories or three accounts. That is personal account, real account, and nominal account. So we'll see one by one. So personal account, in this we have artificial person. Okay, whatever the persons comes in the organization or in the business, okay, there comes under this personal account. For example, debtors, creditors, capital. Capital is a representative person, because the capital who is invested, the owner or the management is invested, correct? A representative person. All the these categories of persons will comes under the personal account. So in that, debit is the receiver, credit is the giver. For example, we are going to receive money from the our customer. So customer is going to pay money. So who are going to receive? The company is going to receive the money, correct? So company needs to debit. And who is the giver here? The customer is the giver, or he is going to pay, correct? So we need to credit the customer. Real account. So in this real account, all your assets, okay, it comes in the real account. For example, purchased plant and machinery. If you purchase the plant and machinery, what comes to the business? Plant and machinery comes to the business. And what is going out? Cash is going out. Correct? So debit what comes in? So plant and machinery comes in. So plant and machinery account debit. 2. What goes out? Cash is going out. So cash account credit. So this is the real account. Next, nominal account. All your expenses, liabilities, okay, and incomes will comes under the nominal account. So debit all the expenses and losses, whatever the expenses or losses are there, okay, that will comes under debit side. For example, rent paid, commission paid, destroyed by fire, okay, or loss on sale of assets, all this comes under the debit. And credit, all your income and gains, whatever the sales, or whatever we are going to receive commission, interest, rent, all this comes under the credit side. So debit all expenses and losses, credit all income and gain as per the nominal account rule. Okay. So this rule first we are going to use in the journal entries. So while passing the journal entry, this is the base for the journal entry. From that journal entry only, we need to start, and then we need to post it to ledger account, trial balance, and financial statements. Here we have the summary. We will quickly recap whatever we have discussed in this video. So in this video, we have discussed bookkeeping. So bookkeeping is also called as preliminary books of accounts. So without this bookkeeping or without this recording, we cannot continue with the other books of accounts or other original books of accounts. So that is the first one we have discussed. Next, accounting. So we have discussed the definition of accounting and the process of accounting. Next, we have discussed functions of accounting. that is recording, classifying, summarizing, analyzing, interpreting, and communicating. So these are the 6 functions are there. We have discussed process of accounting, that is bookkeeping, journal entry, ledger account, trial balance, and financial statement. So this is the flow. In this flow only, we are going to follow our financial statement. We have discussed difference between bookkeeping and accounting. So what are the bookkeeping and what are the accounting? That is also we have discussed. Users of accounting. So in this user, we have broadly classified into 2 categories, that is internal users, external users. So in the internal, we have owners or management, investors, managers, and employees are there. And external users, lender, suppliers, customers, competitors, and government and the public. So these are the users of accounting. Elements of accounting. So 5 elements are there, that is assets, liabilities, revenue, expenditure or expenses, and the capital. So these are the 5 elements of accounting. Types of accounting: financial accounting, cost accounting, management accounting. So these are the 3 traditional types or branches of accountings are there. While it comes to new or recent accounting types, that is tax accounting, human resource accounting, and corporate accountings are there. And we have discussed accounting concept. We have 9 accounting concept: business entity concept, going concern concept, cost concept, dual aspect concept, money measurement concept, accounting period concept, realization concept, matching concept, and objective evidence concept. So these are the 9 accounting concepts are there. And we have 4 accounting convention, that is convention of disclosure, convention of consistency, conventions of conservatism, and the convention of materiality. Golden rules of accounting, that is personal account, real account, nominal account. As per the personal account rule, debit is the receiver, credit is the giver. As per the real account, debit what comes in, credit what goes out. And as per the nominal account, debit all expenses and losses, credit all income and gain. Thank you.
If you haven't subscribed to our channel yet, I want to request you to hit the subscribe button and turn on the notification bell so that you don't miss out on any new update or video releases from Great Learning. If you enjoy this video, show us some love and like this video. Knowledge increases by sharing, so make sure you share this video with your friends and colleagues. Make sure to comment on the video for any query or suggestions, and I will respond to your comments.